Most people think an IRS audit begins when the government suspects evil. That is not how it usually begins. It begins when your story cannot survive a checklist. That is the first thing I want you to understand, because if you miss that, you will spend your whole life fighting the wrong enemy. You will keep defending your intentions when the machine is really testing your proof. You will keep saying, "But this was allowed," while the other side is asking a colder question. Can you show me that is the whole game? Not righteousness, not even legality by itself. Support evidence, sequence. A return can be completely legal and still become expensive. A deduction can be perfectly valid and still die in an audit. A business owner can do nothing fraudulent, nothing reckless, nothing shady, and still end up losing because he confused being right with being able to prove that he was right. That is the hidden danger. The source document says it in plain terms in an audit. The IRS does not have to prove you did something wrong. You, the taxpayer, generally have to prove you did something right. If the IRS asks for support and you cannot provide it, even a legal deduction can be reversed. That is the foundational truth that most people never fully absorb. Faithfully cite Fayturn 42 File 0 Fay. Now let me tell you why this matters so much. Because most adults build their tax life around a fairy tale. The fairy tale says the system works like school. Follow the rules, do your homework, behave responsibly, and if anyone ever questions you, the truth will save you. Tax law is not school. Tax law is closer to a warehouse. Boxes come down the line. An employee with a checklist looks at the label. If the label matches the required pattern, the box moves. If it does not, the box gets pulled. The employee does not need a philosophical reason to pull it. The mismatch is enough. That is why I call the whole audit process the warehouse test. Your return enters the building. The scanner does not ask, "Is this person decent?" It asks, "Does this return look normal enough, documented enough, and coherent enough to move through the system without needing a closer look?" That is a very different standard. And it is exactly why good people get blindsided. They believe they are being judged for morality. They are being judged for documentation. That is the hidden tax lesson almost nobody learns until they pay tuition the hard way. So let me walk you through the real mechanics of what actually triggers an audit, why legal tax positions still get destroyed, and what genuinely protects you when the letter shows up. Because once you understand those three things, audits stop feeling like lightning and start feeling like weather patterns. You still may not enjoy the weather, but at least you know what clouds mean rain. The first mechanism in the story is what I call the burden trap. The source says this clearly, and it is one of the most important ideas in all of tax practice. The IRS does not have to build a case that you were wrong before challenging your deduction. It can simply ask you to prove the deduction. And if your support is weak, the position can collapse. The source goes even further and points out that although the burden of proof can shift in limited circumstances, most taxpayers never meet the standards required to make that happen because they lack proper records, credible evidence, or full compliance with substantiation rules. Faithfully cite Fayturn 42 File 0 Fay. That is why I call it the burden trap. Most people think the default state is innocence. In a philosophical sense, fine. In a practical audit sense, the default state is unsupported until supported. That is brutal language. But it is useful language if you take one idea from this whole story. Take this one. The IRS does not care that the expense sounds plausible in your mouth. It cares whether the support is visible in the file. The file is the battlefield, not your memory, not your sincerity, not what your bookkeeper vaguely remembers, not what your CPA assumed based on incomplete inputs. The file. And this is exactly why so many business owners feel betrayed when an audit begins. They say things like, "My CPA said it was fine, maybe." But what your CPA often means is that the deduction is allowable if the facts and records support it. That is a very different sentence from "you are safe no matter what happens." Safety comes from records, not from permission. That is the first major mental shift. The second mechanism is what I call checklist justice. The source says something that every taxpayer needs to hear. Audits are often handled not by tax philosophers or grand legal strategists, but by government employees following checklists. Their job is not to admire nuance. Their job is to verify boxes. If the documentation does not clearly check the boxes, the deduction often fails. Faithfully cite Fayturn 42 File 0 Fay. This is one of the most important practical truths in the entire system. People imagine the IRS as some kind of all-seeing judge weighing fairness. Number at ground level, an audit is often much more mechanical than that. You say the meal was for business. Where is the receipt? Who attended? What was the business purpose? You say the trip was business travel. Where is the itinerary? Where are the meetings? Where is the schedule? You say the car was for business. Where is the mileage log date? Destination purpose. Miles, it is not romantic. It is not subtle. It is administrative. That is why I call it checklist justice. Not because justice is absent, because the form justice takes is narrower than most people assume. The system is not trying to read your soul. It is trying to close a file. And once you understand that, your entire approach to taxes should change. You stop asking, am I basically doing this right? You start asking, if I had to hand this deduction to a stranger who has 10 minutes and a checklist, would the stranger be able to validate it without needing my life story? That is a much stronger question. And strong questions keep people out of weak positions. The third mechanism is what I call the legal but lost problem. The source gives the perfect example. You deduct a business expense that is absolutely allowed under the tax code, ordinary, necessary, reasonable. Fine. But when the IRS asks you to support it, all you have is a bank statement or credit card statement showing that money left your account. That proves only one thing: money moved. It does not prove what you bought or why it was business related. So the deduction can be reversed even though the underlying expense itself may have been totally legitimate. Fay file a site, Fay turn 42 file 0 Fay. That is the legal but lost problem, and it is much more common than people realize. It is also the reason many honest taxpayers become cynical about the audit process. They think, but this was real. Fine. Real is not the same as substantiated. That is the cruelty. And that is why I never use the phrase, just keep your bank statements. When talking to serious business owners, bank statements are not proof of purpose. They are proof of payment. Payment answers only one third of the problem. The IRS also wants proof of what the thing was and why the business needed it. That means receipts, invoices, contracts, calendar records, mileage logs, notes made at the time, accounting entries that actually connect the dots. That is what turns a legal expense into a defensible expense. Without that bridge, even a proper deduction can drown. Now let me move to the trigger side, because a lot of people still ask the wrong question. They ask, what illegal things trigger audits? Often the answer is much less dramatic. Many triggers are about shape, frequency, pattern, and mismatch, not obvious wrongdoing. The fourth mechanism is losses. The source says, this is the biggest audit trigger the speaker sees in real life. Losses attract attention, especially when they offset other income. That includes Schedule C losses, short-term rental losses, real estate professional losses, large depreciation deductions, and any structure that seems to wipe out income. The source emphasizes that from the IRS perspective, businesses are supposed to exist with an intention to make a profit. Repeated losses cause the obvious question to emerge: is this actually a business, or is it a hobby, shelter, or personal lifestyle with tax language wrapped around it? Fay file a site, Fay turn 42 file 0 Fay. This is why I call losses the attention magnet. A profit says the system is working. A loss says, look here. That does not mean losses are bad. Many great businesses begin with losses. Many valid strategies create losses in a perfectly lawful way. Depreciation is real. Startup drag is real. Build-out costs are real. Rental timing differences are real, but losses are still magnets. They pull attention. And if they offset wages, portfolio income, or other profitable activities, they pull even harder. That is how the scanner thinks. It asks, why is this return so efficient at erasing taxable income? That question alone is enough to raise your risk. This is especially true with Schedule C businesses, because the source correctly notes that these are often smaller, less formal operations. Informality is not illegality, but informality tends to correlate with weaker systems, weaker records, and fuzzier boundaries between personal and business life that makes the losses more vulnerable. This is where a lot of people make a tragic mistake. They hear that losses trigger audits and conclude that the answer is to stop claiming legitimate losses. Not necessarily. The better answer is to make sure the loss position is supported, coherent, and clearly grounded in a real economic activity. The issue is not the loss alone. The issue is whether the loss can survive contact. That is the question you must ask. The fifth mechanism is what I call refund greed. The source specifically mentions amended returns asking for large refunds as another common trigger. That makes perfect sense. Anytime you go back to the government and say, in effect, you took too much, send a meaningful piece back, you are increasing the odds that someone will want to inspect the reasoning. Fay file a site, Fay turn 42 file 0 Fay. This does not mean amended returns are bad. Sometimes they are absolutely necessary. Errors happen, late Quan-S happen, credits get missed, elections get made late, facts change. But large refund claims create attention because they reverse the ordinary flow of money. The system notices reversals. That is why I call it refund greed. Not because the taxpayer is always greedy, but because the machine interprets large amended refund claims as transactions worth reviewing. And here again, the lesson is the same. The risk is not in the concept. The risk is in weak support. If you amend and ask for a large refund, you had better understand that you are stepping onto a brighter stage. That means the file should already be clean. The documentation should already be assembled. The logic should already be narratively strong. If you are improvising after the claim is made, you are already behind. The sixth mechanism is vehicle deductions on personal returns. The source lists these as common triggers, which I think is exactly right. Vehicles are one of the most abused categories in all of tax reporting because they sit right at the blurry border between life and business. Everyone drives. Many people do real business driving. Far too many people then overstate the business percentage, fail to keep logs, or claim use that common sense does not believe. Fayfalicite Fayturn 42 File 0 Fay. This is why I call this category motion inflation. The taxpayer remembers every legitimate trip. The taxpayer forgets every personal trip. The taxpayer then builds a percentage out of selective memory and calls it bookkeeping. That is dangerous. Motion inflation is especially bad because once the IRS asks for the log, the weakness becomes obvious quickly. And remember the warehouse test. The agent is not being asked to admire your explanation. The agent is being asked to verify whether the use is supported. No log, no sequence, weak deduction. It is often that simple. The seventh mechanism is income mismatch. The source points specifically to income mismatches from 1099s. This is one of the oldest and simplest triggers in the whole system. If third-party information returns show one amount and your filed return shows something else, the scanner does not need to be imaginative. It already has a mechanical discrepancy to pursue. Fayfalicite Fayturn 42 File 0 Fay. I call this mismatch gravity. When two official numbers are in the system and they do not line up, the larger machine pulls them together by force. This is not philosophical, it is arithmetic. And it is one of the reasons I always tell people that tax risk is often born not from aggressive strategy, but from neglected reconciliation. The books say one thing, the 1099 says another, the return says a third, the owner shrugs because he knows what really happened. Fine, the machine only knows what was filed. That is why reconciliation is so important. A lot of avoidable audit pain starts with simple mismatches that could have been resolved before filing if someone had respected the paper trail more than their own confidence. The eighth mechanism is what I call category excess. The source mentions deductions that are unusually high for your industry. This is a critical insight because the scanner does not judge in absolute terms only. It judges in comparison. A number that seems harmless in isolation can become interesting when compared with what others in that profession typically report. Fayfalicite Fayturn 42 File 0 Fay. That is why industry context matters so much. A contractor with high fuel, tools, and materials may fit the category. A small consultant reporting those same ratios may not. A software business with ordinary subscriptions and contractor costs fits one profile. That same return, showing outsized meals, auto expense, and travel without obvious business logic, tells a very different story. This is category excess. The number may be real. The issue is whether it fits the lane, and that is where many people drift into danger without realizing it. They do not ask, how does this compare with what the system expects from my type of work? They only ask, can I justify this somehow? That is too weak a standard. You need both support and fit. If the number is large and out of category, your support needs to be especially strong because the outline is already unusual. Now let me move to the ninth mechanism. Correspondence audits. The source makes a very important point. Many audits today are not dramatic face-to-face events. They are correspondence audits, essentially letters asking you to mail in proof. If you fail to send exactly what the IRS wants, the IRS can simply reverse the deduction. Little effort on their side. Lots of effort and time on yours. Fayfalicite Fayturn 42 File 0 Fay. This is why I call it letterbox warfare. People imagine audits as rare courtroom drama. Often they are paperwork attrition. The government sends a letter. You send partial support. The government says insufficient. You try to explain. The government says the deduction is reversed. Now you are in a fight you never expected over issues you thought were obvious, with time bleeding out of your business. This is why audits are expensive even when the tax outcome is eventually favorable. Which brings me to the 10th mechanism. The cost of winning. The source says this directly, and it is one of the most underappreciated truths in the whole subject. Audits are expensive even when you win. Months or years can be consumed gathering records, responding to notices, and proving what you already reported, just to finish where you started. There is no prize, no bonus, just time, energy, and money gone. Fayfalicite Fayturn 42 File 0 Fay. That is why I call it the no upside battle. A lot of people talk about audit defense as though it is only about whether you ultimately owe more tax. The fight itself is costly, especially for business owners. Every hour spent reconstructing records, answering notices, and explaining obvious things to a bureaucracy is an hour not spent making money. This is why the real goal is not merely win the audit. The real goal is make the audit administratively boring. That is a much better target. And that brings us to the fix. The source says the single biggest protector is organized documentation. It says bank and credit card statements are not enough. The IRS also wants proof of what was purchased and why it was business related. That means receipts plus business purpose documentation. It contrasts disorganized owners who lose deductions, despite having statements with organized clients who have a clean general ledger, receipts attached to each transaction, and business purpose documented in real time. Making the audit administrative rather than adversarial Fe turn 42 file 0 Fe, that is the 11th mechanism, receipt architecture. I choose that phrase very carefully, not save your receipts. Receipt architecture, because this is not about stuffing paper into a drawer or taking random photos of slips and praying later. It is about building a system where each transaction already has a chain. Money left the account. Here is the receipt. Here is what was bought. Here is why the business needed it. Here is where it sits in the ledger. That is architecture. Architecture is what protects you, not shoeboxes, not good intentions, not your memory of why the dinner mattered. Memory is weak. Architecture is strong. And the source goes even further with a truth that people hate but need to hear. Documentation created during the audit has very little credibility. Courts often treat after fact explanations as self-serving testimony. What matters most is what was documented when the expense actually happened. Fe turn 42 file 0 Fe, this is the 12th mechanism. Timestamp credibility. A note written today about an expense from 2 years ago is not the same thing as a contemporaneous record created when the expense happened. The first one is advocacy, the second one is evidence, and systems reward evidence. That is why I think real-time accounting discipline is one of the highest return habits in all of finance. It does not feel glamorous because the payoff is invisible right up until the moment you need it. Then suddenly it becomes the only thing in the world that matters. The source says a real accounting system is necessary, not a shoebox, not a spreadsheet floating in the air. You need a system that ties receipts directly to transactions and links them to the books as decisions are made. It specifically notes that when the IRS asks for the general ledger, and it usually will, the difference between having one and improvising one is the difference between administrative review and chaos. Fe turn 42 file 0 Fe. That is why I call the general ledger the spine. A body without a spine collapses under pressure. A tax file without a proper ledger often does the same thing. The ledger is not glamorous. Good. I like things that are effective without needing applause. The ledger is where memory becomes structure. That is why it matters so much. Now I want to talk about myths, because the source very helpfully points out that not everything people fear is actually a trigger. Home office deductions are common and rarely the issue by themselves. Cost segregation has been around for decades and is not automatically a problem by itself either. The source's deeper point is crucial. The strategy itself is not what creates danger. The danger usually appears when the strategy is tied to losses and weak documentation. Fe turn 42 file 0 Fe, this is the 13th mechanism. Myth fog, the public is often afraid of the wrong things. They fear labels instead of support. They fear techniques instead of implementation. They fear words like home office or cost seg, when the real issue is almost always whether the return tells a coherent, well-supported story. That is why I always try to clear the fog first. The category name is not what protects or kills you. The execution does. A conservative deduction with terrible support can be weaker than an aggressive but properly documented position with excellent support and clean narrative logic. That is the level where the game is actually played. Now let me bring all of this together into one operating system, because disconnected advice is cheap. I call it the audit-proof chain. First, assume every deduction must survive the warehouse test. Could a stranger with a checklist validate the claim without needing to hear your emotional explanation? Second, respect the burden trap. Do not assume legality protects you if support is weak. Third, identify attention magnets, early losses, refund claims, vehicle deductions, mismatch categories, industry excess. If the return contains magnets, the support must be stronger. Fourth, build receipt architecture, not later. Now at the time of the expense. Fifth, keep a real ledger, not a memory collage, a ledger. Sixth, make the story coherent. The return, the business, the books, the lifestyle, the deductions, the categories, the receipts, the calendar. Do they all describe the same reality? That is the real question. If yes, you are hard to hurt. If no, you are exposed, even if you think you are basically following the rules. That is the whole point. And now let me tell you the harshest truth of all. A lot of people do not get hurt because they were greedy. They get hurt because they were casual. Casual with receipts, casual with categories, casual with logging mileage, casual with explaining meals, casual with losses year after year, casual with spreadsheets instead of systems. Casual is expensive because casual creates gaps. And gaps are where the audit lives. The government does not need a dramatic case. It needs a gap wide enough to pull on. That is why I respect systems so much. Systems close gaps before the scanner ever sees them. That is the real protection. Not confidence, not theory, not what some marketer on TikTok told you was totally fine. Real planning, as the source says, is not just ideas. Ideas without implementation and support are not planning. They are risk fe felicite fe turn 42 file 0 fe exactly. And that is the line I want to leave you with. If your tax strategy lives only in your head, it is not strategy. If it lives only in your CPA software, it is not strategy. If it lives only in a folder full of bank statements, it is not strategy. A real strategy lives in records, receipts, ledger entries, business. Purpose notes, clean categories, and a coherent story that can survive contact with a stranger who does not know you and does not care about your intentions. That is how audits stop being mysterious. That is how they stop feeling like random punishment. You realize they are not storms from the sky. They are stress tests on your chain, and if the chain is strong, the audit becomes annoying instead of catastrophic. That is a huge difference. So stop asking, could this get me audited? That question is too small. Start asking, if this ever gets questioned, is the chain strong enough to survive without me needing to give a speech? That is the better question. That is the adult question. And that is the question that keeps a legal deduction from becoming an expensive loss. Because what actually triggers an IRS audit is often not evil. It is weakness in the outline. What protects you is not innocence. It is support. And in taxes, support is what separates the person who panics when the letter arrives from the person who simply opens the file and starts checking boxes.